Hi, how are you guys? Welcome back to the channel. I hope you all crossed the year safely, and happy new year to all of you. So today we are going to look at the type of entries that I use. Basically, for my trading system, I only use two type of entries. There's a risk entry and low risk entry. Risk entry, it has a high risk to reward compared to the low risk entry. The risk entry, the reward might be low, but the risk is also low. For the high risk entry, the reward is high, but the risk is too much. For the high risk entry, I normally enter at the top of structure. So I'll show you. For example, you can see this structure right here. It touched this channel three times, and it gave me a signal that it was about to reverse. You can see one, two, three. So on the third touch, I you enter from around here, and you place your stop loss just above the structure. Your first TP should be on the trend line, and if the market breaks the trend line strongly, your TP should be below the structure around here. For the low risk entry, I don't enter above the structure. I wait for the market to reach above the structure, impulse down, and then correct. I enter on the break of the correction at around here. After the first impulse correction, you can enter here with a reduced risk entry, your stop loss just above the structure, and your first take profit area should be on the trend line. If the market breaks the trend line strongly, your take profit should be below the structure. And sometimes the market doesn't impulse and correct inside the structure. It might just reverse from above the structure and break the structure strongly. With that, you can enter from on the break of the structure at around here. But with this, the stop loss is usually very big, so your risk to reward will be very small. As you can see, if I was to enter here and place my stop loss above the structure, my stop loss will be very big and my reward will be very small. So on this, it depends with you. If you backtest it and you find that you lean towards the low risk entry, it's up to you. If you backtest these entries and you find that you lean towards the high risk entries, it's up to you. So we'll look at these entries on the chart. Examples. We'll start with an example on the euro dollar. As you can see, the euro dollar was forming a rising wedge and it had impulse down. So it was giving me a sign that this was a continuation. After the first touch on the rising wedge, first, second, and the third touch, I was expecting the market to reverse back down to continue going back down. So after this red candle here, the retrace candle, I entered from there. My stop loss was just above the structure, and I held the trade to below the structure. You can see ahead it has a risk to reward of 1 to 8. If you risk 1% of your capital, you'll gain around a 8% profit. On this same structure, we also had a low risk entry where after this the market went back up, it formed a double top up here, and then if you check on the 15 minutes, you can see that it impulsed down and then formed a small correction here. On this, you could have entered on the break of this small correction. Me, I didn't enter because I was already on this first trade and the market had not moved far enough from my stop loss for me to break even my first trade in order to enter this. This you could have entered from around there, place your stop loss just above the structure and take and go down with the market. There was also another low risk entry after the break of the structure. You could have entered around here. And also remember, whenever you are adding positions on top of, you are adding trades on top of other trade, normally you should make sure that your first trade is on break even, because you might add a position and then it doesn't go according to how you're expecting. The market moves back up. Like for this one, I did not enter this trade because I knew the market could just come down a little and then go back up and stop me. And I normally risk 1%, so I would have lost 2% instead of 1%. That's why I didn't enter this one. But for this one, I entered because already I had moved my stop loss to 3% profit, and after I entered this other trade, I moved my stop loss to around 4% profit. We will check another example on the same pair, euro dollar, which is a low risk entry, and there is also a high risk entry. You can see here the market was forming an expanding triangle, and it already touched the expanding triangle one time, two time, and on the third time is when I entered. And it was also forming a rising channel, which convinced me that the market was about to continue down. So when the market reached here, it didn't exactly touch the expanding triangle the third time, but it slowed down. As you can see, this candle right here, it was strong, and then it reduced, and then it reversed back down. On this red candle here, bearish candle, I entered from here, placed my stop loss just above the structure, and I took the market down with me. There is also another option which I didn't take because I had not broken even my trade. You could have entered from around here on the break of this structure and place your stop loss just above those candles and take the market down with you. Or if you are patient enough, you could have waited for this continuation pattern here after the impulse. As you can see, the market impulse down, and then it formed a continuation pattern. You could have waited for the market around here. On the third touch of the continuation pattern, you could have entered with either a risk entry around here, stop loss above the structure, and go, you take the market down with you to make profits. Or you could also enter from around here with a reduced risk entry on the break of the structure. Your stop loss just above the structure, and you see, if you would have entered from there, your reward would have been less than someone who entered with a risk entry above here or here. So we'll look at other examples. We'll go to out New Zealand. There was a trade here that I had taken some time back. I will start with how I got to spot this trade. We will go to the weekly time frame. On the weekly time frame, I saw that out New Zealand was going to a double top area. If you go to the daily time frame, you can see that it was forming a rising wedge, which is a sign of a reversal, adding to my confluence. So when you go down to the 1 hour time frame, you can see that on this structure, the market has touched the structure two times already. One, two. So on this, I was waiting for the market to reach on this that touch for me to enter. So on the third touch, I entered with a risk entry where I made the this was the biggest trade for me in September. I made for the first trade, I entered here with a risk entry. After seeing this rejection, the market as it was heading to the trend line, it started slowing down, and then it formed these two red candles. I entered from here. At this time, I had not woken up, so I entered the market from here. I entered my trade from there. I placed my stop loss just above the structure. After it got here, I'd already I already moved my stop loss to break even here. So the market came back up and stopped me out. But after a few hours, I spotted another trade. As you can see, this candle had a big wick, which is a sign of rejection. And after the retrace candle, this one, I entered again with my stop loss just above here. And remember, guys, this was a risk entry. The market could have retraced and then moved back up again and stop me out. So that's why we call them risk entry. For me, this trade played out. After the market got to around here, I moved my stop loss to break even and the market moved up. It missed my stop loss with like 2 or 3 pips and then the market played out, it went down. It also gave us other opportunities to enter. If you wanted to enter with a reduced risk entry, you would have entered around here, which I didn't take this trade because I was not around my trading desk. This was also another trade opportunity which you would have entered around here with a reduced risk entry on the break of the trend line with a stop loss just above the structure, and you take the market down with you. We will look at other trades. We'll go to New Zealand Swiss franc. There was also another trade which I took here, which was a. I'm still on this trade, which I took with a risk entry. If you look at the 4 hour time frame, you can see the market was forming a structure which looks like a rising channel, and there was also a double top here. The market was coming to test this double top here, and on that double top, if you go to the 1 hour time frame, I was supposed to enter from here, but the market I had not reached on the double top area, so I didn't enter. This was also another trading opportunity which I didn't take because I was not around my trading desk. I would have entered here with a risk entry, but I didn't take it. I was not around my trading desk. I would have entered around here, the stop loss above the structure. This you would have taken small profits or break even because you see it would have been around 5%, maybe small profits of like 3% or 2%. So the trade which I took was this one. The market came down and then it formed a structure which was coming back to form a double top with this previous high here. As you can see, there was a double top here. And to add to my confluence, the market just pierced above the double top and then came back down again. So I entered from here. This one I didn't take it. I just put a sell stop around here and then went to sleep. In the morning when I woke up, I found that the market had triggered me in and it moved down. For now, I've locked my profit at around 2%, not at around at 2%, because I've seen that I can see that the market is moving down. It has already impulsed down and it is forming a form of a continuation pattern here. So on this continuation pattern, if it gives me a that touch and a retrace candle, if it comes up like this, it gives me a that touch and then a retrace candle, I'll enter with a risk entry. But if it doesn't do that and it just impulse down and break the structure, it comes up, impulse down, I'll enter with a sell stop here on the break of the structure, stops above the structure. It will be too high, but if we go to the higher time frame area, we can see that the market will be going to around down here and the risk to reward will be high. So guys, that has been our lesson for today. Tomorrow we'll be looking at how to trail your stop loss, and how to take profits. Thank you for watching, and if you have any question, please ask on the comment section, and please subscribe and recommend others to these videos. Thank you.